Welcome everyone to SEMLA's weekly webinar. This week is our great pleasure to receive Anton Korinek, who is an assistant professor at the Department of Economics at Johns Hopkins University. He is also a research fellow at the National Bureau of Economic Research, and he received his PhD from Columbia University in 2007 after working for 3 years in the financial sector. He has also worked at the University of Maryland and has been a visiting scholar at Harvard University, the World Bank, the IMF, the BIS, and the Bundesbank. And his area of expertise is international finance and macroeconomics. In his current research, including the presentation that we'll hear today, Anton focuses on capital controls and macro-prudential prudential regulation as policy instruments to reduce the risk of future financial crises. Among his work, he investigates the global spillover effects of such policy measures, as well as their implications for income inequality. He has won several fellowships and awards for his work, most recently from the Institute for New Economic Thinking. So again, it is a great pleasure to have Anton today with us. I just want to remind you that there are several ways in which you can interact with the speaker, either asking questions by raising your hand in the set status icon, or you can write them down here in the chat window that you have on the lower right part of your window. So thank you very much, Anton.
Thank you very much for the kind introduction, Alberto, and thank you for inviting me to speak at this distinguished webinar series. This is my first webinar, so I'm especially excited to present to so many different researchers spread around the world. So the topic of my talk is regulating capital flows to emerging markets. This is an area of research that I have been active in for quite a number of years. And what I'm going to present today is based in part on 2 papers that I believe have been distributed that I wrote earlier, and also some new research on how to apply my findings on optimal capital flow regulation using a new empirical methodology that I think allows us to capture the externalities created by capital flows in a more reliable and more robust fashion. So having said that, let me jump right into the motivation. So we all know that emerging market economies experience periodic booms and busts in capital flows. The booms lead to a period of strong growth, and they increase the liabilities of borrowers, the financial sector, but also households and the industrial sector in emerging economies. And all too often, the booms are followed by severe busts, by what Guillermo Calvo has called sudden stops. And these sudden stops in capital flows frequently lead to severe crises. So the main questions that I want to investigate in this presentation today is, are free capital flows to emerging economies desirable? And I think you can already guess my answer from the title of the presentation. If not, what can we best do about them? What can we best do so that we can enjoy the benefits of global capital markets while also protecting emerging economies against the pitfalls that are created by frequent financial crises? So the approach that I'm going to take is the following. So we economists, we generally believe that we don't want to just blindly intervene in markets. Whenever we intervene, we want to base that intervention on a clearly identified market imperfection. So what I'm going to do in the presentation today is I will focus on the mechanism of financial crisis that we want to avoid. So I will focus on what actually happens during financial crisis, and is there some inefficiency, something that we should regulate that occurs during these financial crises. Now specifically, I will use a framework that has first been developed by Calvo, later on by Paul Krugman, and also Enrique Mendoza, a framework of financial amplification. And before I explain this term and this mechanism in more detail, let me also refer you to the empirical evidence that researchers at the IMF and Carmen Reinhardt, Ken Rogoff, and many others have accumulated over the past decade. So we have found that equity flows, and especially foreign direct investment, actually enhances growth and risk-sharing opportunities for emerging economies. On the other hand, debt flows, and in particular foreign currency-denominated debt and short-term debt, has been shown to significantly raise crisis risk and does not seem to have any beneficial effect on growth. So this empirical evidence is strongly suggestive of a role for regulatory intervention, and in particular intervention that distinguishes between the more benign forms and the more dangerous forms of capital flows to emerging markets. And that's the kind of approach that I will also take in this presentation. So let me talk a little bit about the mechanism of financial amplification. Sometimes people call financial amplification, I've illustrated it here on the slides with a red feedback loop. Sometimes people call financial amplification just a financial feedback loop, or they call it debt deflation, financial accelerator. Those are all basically the same mechanisms playing out, and people in the literature have given it slightly different terms over time, but it's basically all the same. So what happens during an episode of financial amplification, and I will argue that this is exactly what happens during an emerging market crisis, is that capital markets create their own pro-cyclicality. So imagine we have an economy that gets hit by some adverse shock. For example, let's say there is an exogenous outflow of capital. That generally leads to a decline in the exchange rate, and we can see that by the next red arrow. Now, the declining exchange rate implies that emerging market borrowers suffer balance sheet effects. They suffer a decline in their borrowing capacity, a decline in their collateral, and that's the next effect in this feedback loop. Now, if the borrowing capacity of borrowers contracts, that means they cannot roll over their debts, they have to repay the foreigners, and it leads to additional capital outflows. So that means our feedback loop has come full circle, and these additional outflows lead to further falling exchange rates, further declines in the collateral value, even more outflows, and so on and so forth. In fact, these effects can be so strong that they can even lead to self-fulfilling crises, but that would be the topic of a different talk. So the main finding in this literature and in this presentation is that if we have such a feedback loop from capital outflows to falling exchange rates to falling collateral and so on and so forth, these feedback loops involve a pecuniary externality. So pecuniary externality means that it is an externality that acts on prices, that's why we call it pecuniary, and it is an externality because each individual agent in that economy takes prices as given. That's what private agents generally do. But they do not internalize that as the exchange rate falls, as the exchange rate is the important price in this mechanism, as the exchange rate falls, they hurt the borrowing capacity of other borrowers. And that's where the externality comes in. So basically, if I am an emerging market agent and I borrow too much, and let's say too much in short-term dollar debt, I can hurt your borrowing capacity if you're another borrower in that economy. That's the externality. So now, in some sense, if we find an externality in economics, that creates a natural basis for intervention. And in our particular framework, it gives us both the theory for how the crises happen and also a theory of how to optimally intervene in capital flows. So in some sense, we kill two birds with one stone. We get the theory of the crisis and also of the optimal intervention. So let me briefly relate this to the existing literature and then point out what the main contribution in my talk today is. So there has been a growing literature on capital controls and pecuniary externalities in recent years. It was kind of started by Caballero and Krishnamurti, and then I have made a number of contributions, and a number of other people, my co-author Olivier Jean, Javier Bianchi, Gianluca Benigno, and his co-authors have contributed to this literature. In the past 2 years, there has been a separate strand that motivates capital controls based on externalities, but that look on aggregate demand externalities. So this is a literature by Stephanie Schmidt-Grohe, Martin Uribe, and by Emmanuel Fari, Ivan Werning. Now, and finally, there has also been a growing empirical literature on capital controls. So it's probably best if I just point you to a recent survey by Nicolas Magud and co-authors who serviced this literature and who shows actually that the main reliable effect of capital controls is precisely something that I'm pushing in this paper, which is to change the profile of emerging market liabilities from dangerous forms of finance, such as dollar debt, to more state contingent forms of finance, such as local currency debt. So now specifically, what's the key contribution in my talk today? So the key contribution is that I analyze state contingent capital flows. That means I consider that emerging economies can trade in different currencies, in equity, different maturities, and so on and so forth. So this allows us to better capture the actual market environment in which emerging markets nowadays operate. Secondly, this allows us to focus on how to regulate different types of capital flows. So I will find, for example, and I will document this empirically, that FDI is much safer than local currency debt, which in turn is far safer than dollar debt. And in the end, we can achieve much greater welfare gains by letting in the safe types of capital flows and regulating the risky ones rather than by just applying some homogeneous level of regulation on all capital flows. A third contribution of the paper will be that I develop a simple sufficient statistics approach to quantify these externalities that we are finding. I will argue that this is a simple and robust framework that allows us how to quantify optimal Pigovian taxes, and it is a framework that can be easily replicated from readily available data in order to inform policy analysis. So I think this is also an important innovation in the paper that I'm about to present. So on my next slide, I will start laying out my benchmark model. So let me maybe pause for a moment And let me ask if any of the participants has a question up to this point. Okay, I see no electronic hands raised. Feel free to interrupt me at any time if you have questions. So there is a function, if you click on your name, to basically raise your hand and inform Alberto that you have a question. So feel free to do that at any given time. Oh, I see. There is a question in the chat box. So Alberto is asking, in my view, externalities are the most important source of financial market inefficiency, and I even perform the analysis with complete markets.
Can I complete the question? Perhaps it is faster than writing it down. So,
please, yeah.
And how do you? I guess you also recognize that market incompleteness could be also a source of financial market inefficiency, and market incompleteness perhaps due to asymmetric information problems that could be a common characteristics of this international borrowing lending, or lack of commitment could be another source. So why choosing externalities? Do you think that it is the most important one, or for example, this lack of commitment that in the early literature was part of this sovereign debt main issue? Could you comment a little bit on that?
Yeah, I think that's an excellent question. So I certainly agree with you, Alberto, that incompleteness of financial markets and lack of commitment also plays a major role in financial market transactions with emerging economies. So let me maybe also add just something about the word externality. So in principle, any form of market incompleteness or also lack of commitment can create externalities. So in some sense, I would formulate your question as being about externalities that are driven by financial amplification versus externalities that are driven by, for example, lack of commitment. Now let me start maybe with the lack of commitment. So lack of commitment arises, for example, when an emerging economy refuses to repay its creditors. That would be the most archetypical situation of lack of commitment that's considered in this literature. So in that particular case, there is a government which basically makes a decision on behalf of the entire economy not to repay. And if that happens, it does not constitute an externality, because the government, well, it depends on the motives of the government, right? So if the government acts in a more or less benevolent way, then the government would realize, for example, we are completely out of funds, we cannot possibly afford to repay our debt, and then that would actually be the optimal choice in such an environment. Now, if the government does something that's crazy, if it just defaults completely opportunistic, even though the funds would be here, then that would impose an externality. But in that situation, we cannot really ask that government to regulate capital flows and expect to improve anything, because that government clearly does not care about the welfare of its domestic agents. So in a sense, the reason I'm focusing on financial amplification effects on these feedback loops is because there's something that's driven by the private market that can occur even if the government acts with the best intentions. And for example, government default oftentimes involves situations where the intentions are not the best. And then I think it is difficult to expect that that government that just defaulted will do its welfare calculation and optimally regulate capital flows. Does that answer your question?
Yeah.
Okay, I read thank you in the chat box. So if anybody else has questions, please feel free to interrupt me at any time. So otherwise, let me start by explaining my benchmark model in which I'm going to analyze all these effects. And let me maybe magnify the slide a little bit because we get into the algebra intensive part now. I should also say the algebra will be over again in about 5-6 slides, and then I will look at a lot of data. So the benchmark model in which I will analyze these externalities is a small open emerging market economy in infinite time in which there is uncertainty. Now uncertainty is captured by a state of nature omega that I have I'm pointing the cursor at, and there will be two sets of agents that interact in the economy. One of them are large international investors, and I will assume that this is a small economy, so the pricing kernel, or otherwise the price that international investors are willing to pay for emerging market debt or emerging market equity, that's just exogenous. So these international investors, they're willing to buy up any state contingent payment stream from our domestic agents. The next set of agents are domestic representative borrowers. And these domestic borrowers, they just maximize their utility, as domestic borrowers always do, and they maximize the discounted stream of period utilities, and period utility depends on both traded and non-traded consumption. Now the maximization problem is subject to a budget constraint. The budget constraint just says that whatever we consume in both traded and non-traded goods, plus this expectation term here, captures the total amount of securities that we issue in all the different states of nature. So that's basically the amount of new finance. And that has to equal our endowment of traded goods plus our endowment of non-traded goods plus the financial wealth that we carry into the period. So let me maybe spend a few words discussing why the total amount of finance issued is given by this expectation term. So as I mentioned, one of the contributions of this paper is to allow for different types of state contingent securities. So we can have, for example, dollar debt, we can have local currency debt, we can have equity, and in fact I allow for a full Arrow de Breu market of securities in this environment. And each state of nature omega will have a certain pay of BT omega. I can see that my cursor is obscuring part of the algebra, so let me remove it again. So each state of nature allows us to make a payoff contingent on that state of nature, and international investors are willing to pay an amount M for each unit of payment contingent on that state. So if we add up M times B across the different states of natures and multiply it with the probabilities of these different states, that gives us the total amount of finance raised. And that's precisely the expectation of MT times BT. So we have discussed this term in the budget constraint. Now there is a second line here, which is a financial constraint. And let me now jump back to our previous view. So the financial constraint here, it just says that the total amount of security issuance, the E of MT plus 1 times BT plus 1, that's what we issue in total. That has to, and I will underline that, that has to be covered by the total value of collateral. And in order to capture the total value of collateral, I use a formulation that has been popularized by Enrique Mendoza. So the total value of collateral is given by the second curly line here. And the assumption behind this is basically that individual domestic agents can pledge at most a fraction phi of the value of their income in the current period. So in the paper I show that this can actually be motivated from a moral hazard problem in which basically agents will run away if their debts are higher than a certain fraction of their income. And given that moral hazard problem, we obtain a financial constraint just like the one in the second line here. So again, the total value of our financial claims, the E of MT BT plus 1, which is generally negative because we have issued financial claims, has to be covered by the total value of our collateral, which is the curly part in the equation. Now, our domestic agents receive and consume both traded and non-traded goods every period. And something that I think I have not specifically mentioned yet, but that may have become obvious to you, the price PT in this formulation of the problem is the relative price of traded goods, of non-traded goods in terms of traded goods, which generally represents a measure of the real exchange rate in these environments. So, as I said, these individuals can trade arrow securities contingent on the future state of nature, and that means they can insure or take risk depending on whatever they like, and that feature that they are allowed to take on risk is what will allow us to capture the potential for both dollar-denominated and local currency-denominated or equity securities later on. So let me maybe come back to one point that Alberto brought up 2 slides ago. Alberto said, well, should we really believe that these markets are absolutely complete? So my answer that I'm suggesting here in this framework is, if our emerging economy can trade financial assets that have different state contingencies, then it shows us that international financial markets are at least to some extent complete. And I think the problem many times is that the price at which international investors are willing to buy securities from the emerging economies, and that's this MT plus 1, the pricing kernel that I have just circled on the slide, that price is sometimes very disadvantageous for emerging market countries. So for example, some countries find it extremely expensive to issue local currency debt. And that's all captured by this price here. So in that sense, I think the framework can capture a feature that a lot of emerging economies experience nowadays, that they do have access to some state contingent securities, but that access is very often quite expensive. I see Alberto is typing a follow-up question or answer. Yes, okay. So that's a very good question. Alberto is asking, what is the uncertainty tied to? And in the model framework, uncertainty is tied in particular to the YTT. It can also be tied to our collateral parameter phi. It can also be something that's completely independent of the emerging economy. It can be, for example, risk aversion in international financial markets that induces international investors to suddenly pull back their funds and to give rise to contagion. So in some sense, the uncertainty parameter omega can capture a very broad level of uncertainty. So all 3 phenomena, income uncertainty, uncertainty about the collateral parameter and how much we can borrow against our collateral, and also international risk aversion, would all be captured by this parameter. So let's next come to how the equilibrium in this economy is determined. So there are two important optimality conditions of our domestic agents. The first one tells us how domestic agents determine the real exchange rate. And that optimality condition just comes from the first order condition on non-traded consumption. So in equilibrium, our domestic agents always want to consume traded and non-traded goods in a way that corresponds to the price of traded versus non-traded goods. Now, since this is an endowment economy, our domestic agents have to eat up the total available supply of non-traded goods, and the real exchange rate will always adjust in order to clear that market. So, for example, if traded goods are very scarce in the economy because our international investors pull out all the traded goods, then the CT on this slide will be low. And as a result of that, traded goods are scarce, non-traded goods are abundant, so the relative price of non-traded goods will decline. And that just captures the basic intuition that our real exchange rate depreciates when the economy experiences a very low volume of traded goods or a very low volume of traded goods demand. So all in all, this equilibrium condition tells us that the real exchange rate in the economy is an increasing function of the traded goods consumption of the economy. Or if we want to generalize it a little bit, the real exchange rate is an increasing function of aggregate demand in the economy. Then there is the second optimality condition, which is the intratemporal optimality condition, kind of the Euler equation of our domestic agents. The Euler equation tells our agents how to allocate consumption across time and also how to allocate it across different states of nature within the next time period. And it's given by the second equation here on the slides. So the second equation just tells us that our domestic agents want to equate the marginal utility of traded consumption today to the relative marginal utility of traded consumption tomorrow, taking into account their own discount factor beta and the stochastic discount factor of international investors, which is this M variable. Now, notice there's also a mu in this equation. So mu is the shadow price on the financial constraint of our domestic agents. If they're unconstrained, then mu is equal to 0. And then what the equation captures is just that our agents optimally equate their marginal rate of substitution in each of these different states of nature with the marginal rate of substitution between today and tomorrow of our international lenders. So in a sense, there is perfect insurance between domestic and foreign agents going on, and the financial constraint is irrelevant. On the other hand, if the financial constraint is binding, then this mu variable will be positive, and mu will place a wedge into the Euler equation of our domestic agents. They will still choose to spread risk across the different states of nature omega tomorrow, but they cannot issue quite as many securities as they would like to. And in that sense, intertemporal smoothing between our domestic and foreign agents is inhibited. So now one important assumption that we make in the framework is that domestic agents are on average impatient. So it means their beta is less than the expected discount factor of international investors. Now, what does this assumption do? Well, it guarantees that over time, our domestic agents, which are impatient, want to accumulate more and more and more and more financial liabilities until at some point they run into the financial constraint. And in the ergodic equilibrium of the economy, in the stochastic steady state basically, the economy will jump between periods when it's unconstrained and periods when the financial constraint suddenly binds, depending on the realizations of the output shock omega. Now, as Alberto pointed out before, the omega can refer either to a domestic income shock or to some international shock to international investors' risk aversion. So the economy can hit these binding constraints either because the economy itself has a bad outcome or because our international investors suddenly panic, let's say, for example, because something like the 2008 mortgage crisis happens in the US and international investors suddenly all pull out their money. So both of this is possible. I see there is a question, does the Euler equation hold in expectations? So yes, it does. So this equation that I have listed here on the slide, the second equation on the slide, it is a state contingent equation that holds in every state of nature. And as the person asking rightly points out, it will also hold if we take the expectation of both sides of this equation. So we can just add an expectations operator here, and the whole equation will still be valid. So what does that tell us? It tells us actually that even if the economy only had non-contingent bonds, then a version of the economy in expectations would still describe everything. But yeah, so it holds both in each state of nature and also in expectation. So let's analyze how these financial amplification dynamics that we showed in the feedback loop on one of the first slides, how these dynamics actually play out in the model. So if the financial constraint binds, then the amount of liabilities that our domestic economy can issue is determined by this binding constraint. And remember, the binding constraint was given by this part of the equation that I have just underlined. So we borrow as much as the binding constraint allows us, and then the consumption of our domestic agent is simply let me use the pointer again, is simply the traded endowment of our domestic agents plus the wealth that they carry into the period plus the maximum amount of liabilities that they can issue. So now what happens if this constraint is binding and if we impose a tiny little shock on the agent? So let's assume we have a binding constraint in the economy, and now I shock the net worth of the position, the net worth position of the agent by a little bit. Let's call that little bit dB. How much will consumption change when dB in the economy changes? And that's the thing that I have put as the next equation here. So the change in consumption in response to a change in net worth in the economy is actually greater than 1. And in particular, what happens as we increase the net worth? So the first thing that happens is, and now I jump back to the first equation, is if we have higher net worth and we are constrained, we are going to spend it, right? So that higher net worth will directly feed into consumption, and that's captured by this number 1 here in the second equation. In addition to that, if everybody increases consumption, if everybody increases aggregate demand in the economy, that appreciates the exchange rate, which will relax the constraint. Now, how much will it relax the constraint? By phi times p prime, and that's captured by the second term here in the lower equation. Now, if net worth goes, or if our borrowing capacity goes up by this additional term, phi times p prime, then we can consume even more, which leads to a second round effect. It appreciates the exchange rate again and relaxes our collateral constraint again. And that would enter as a term phi p prime square. And then there's a third round effect, phi p prime to the cube, and so on and so forth. So it will essentially lead to a geometric sum, and the total of this geometric sum is given exactly by this equation 1 over 1 minus phi p prime. And yeah, this term is greater than 0, capturing the fact that additional net worth leads to an amplified change in consumption. So that's precisely the financial amplification dynamics that we illustrated before in the red feedback loop. Now the interesting thing is, this price movement, this feedback spiral, is also exactly the source of the pecuniary externality in the model. So that's what we will analyze in the following. But before I go to the pecuniary externality, let me maybe also quickly illustrate the policy functions of private agents in such an economy. So what I have depicted here is the level of consumption, that's the middle line, I have just put the green arrow in it, the level of the exchange rate, and the total level of liabilities issued by our domestic agents. What you can see is there's a vertical line here in the first third of the graph roughly, and that vertical line basically indicates at what level the financial constraint on the economy will become binding. So on the horizontal axis, we have the net worth of our agents when they enter the period. That's the little b at the bottom right. And if the little b is very low, then we are in the constrained region. So I'm marking that region and I will label it CON as in constrained. On the other hand, if in an area where we have sufficient net worth, I will mark it in green, we will be unconstrained. I will mark it by UNC, like unconstrained. And so let's see what happens to consumption and to the real exchange rate and so on. As we increase wealth, that means as we go from the very left of the graph further and further and further right. So if we are in this constrained region, you can see that consumption rises very quickly in additional net worth. And the reason is that additional net worth will lead to these amplification effects. So any change in net worth leads to an amplified change in consumption. It leads to a positive feedback loop, and the positive feedback loop involves rising consumption and also a rising real exchange rate, as you can see from the top line here. On the other hand, if we look further down in the diagram, you can see that as the real exchange rate appreciates here, the amount of financial liabilities that we issue actually goes up. And what's the reason for that? So if the liabilities issued go up, that means the total issuance E of M prime B prime goes down because liabilities enter negatively in this framework. So the reason is, as the exchange rate appreciates, we have more and more and more collateral. Therefore, we can issue more and more and more liabilities, and that pulls the amount of liability issuance E of M prime B prime down. Now, at some point, the economy will hit the region where it becomes unconstrained. And that's this vertical line that I'm drawing right now. If the economy becomes unconstrained, then consumption suddenly responds much more smoothly to increases in net worth. So the consumption function is basically flat in this area, as you can see. The real exchange rate is also basically much flatter than in the region where we are constrained and where we have the financial amplification. And the interesting thing is the total security issuance, which is the bottom line, now goes up the more the security issuance goes down, so it means the total debts go down, and our net worth position, E of MB, goes up. So the more wealth we enter with into the period, the more wealth we will leave the period with. And so it means in this unconstrained region, net worth or securities carried into the next period is a monotonically increasing function of our current net worth. In this constrained region, the opposite happens. More net worth relaxes the constraint and actually allows us to increase security issuance. So it means our net worth that we carry into the next period here in this region is a declining function of our current net worth. So that basically captures the mechanics of financial amplification in the model. Does anybody have questions about this? Otherwise, as a next step, I would move into the optimal policy analysis. So I see there is somebody typing a question. Let me wait for one moment. And maybe in the meantime, I will clean up my board. Okay. So Alberto asked, is there a way to identify when the constraint binds in the data? So what I'm suggesting in this paper is this is an aggregate constraint. In the model, we have a representative agent, right? And in the real world, we need to map the whole economy into this representative agent if we want to make meaningful predictions. So I would call an episode as having a binding constraint when there is really a systemic financial crisis in the economy. So a systemic crisis is a crisis where the majority of participants in the financial sector are really constrained. So for that reason, I equate financial crisis and episodes of binding financial constraints with each other. And in the empirical analysis to follow, I will just say binding constraints equates a crisis, because this is really the representative agent. So we're talking about all sectors in the economy being constrained. Now, Culver asked the question, by taking the pricing kernel as exogenous, is the mechanism missing something important related to the risk premium? So that's an important question. So let me maybe distinguish 2 points about that. First of all, if there are variations in the risk aversion of our international lenders, then those variations are simply captured by the externality pricing kernel that I have assumed on our international investors. So exogenous international changes in risk premia are captured by the model. Now the second question, or the second part of the question is, how should we think about increases in risk premium, for example, because of an increase in default risk? So if we want to map a bond with potential default into an arrow-debreu framework like this one, we need to take into consideration that default is essentially part of the state contingent contract. So whenever somebody enters a debt contract and there is a possibility of default, we can view that as an ex ante part of the contract. And lenders typically raise the risk premium in the good states of nature when the borrower repays, in order to make up for the losses in the bad states of nature when the borrower doesn't repay. And in that sense, if we just look at the increased state contingent payoffs in the good states of nature that make up for the bankruptcy losses in the bad states of nature, this Arrow-Debreu framework can also capture the existence of risk premia on debt contracts. Does it make sense, Kolber, or do you have a follow-up question? You're very welcome. Okay, so let's move on to the optimal policy analysis in this framework. What I'm going to do is I will introduce a Ramsey planner who maximizes precisely the same level of utility, the same utility function of our domestic agents and subject to precisely the same financial constraint. So the planner is not able to somehow magically absolve the economy of being financially constrained. That would be kind of an unfair planning problem, but the planner has to observe the same constraint. Now, the only important difference between the planner and our domestic agents is that the planner internalizes that the exchange rate is an endogenous function of the macroeconomic aggregates in the economy, and in particular that the exchange rate depends on the level of traded consumption or traded aggregate demand, as we can call it. So if we solve this planning problem, the planner arrives at a very similar optimality condition for traded consumption as our private agents. And I have listed the condition here in the first line. I'm making a bracket around it. So basically what the planner internalizes, and that's captured by this shadow price that I call lambda tilde. So lambda tilde is the planner's shadow price, and in the line below lambda will be the shadow price of our private agents. The planner's lambda tilde, so the planner's shadow value of traded goods in the economy, of traded consumption in the economy, is that we have a marginal utility of traded consumption, which I denote in short by UT. And in addition, the planner also recognizes that additional traded consumption will appreciate the exchange rate, which will relax the constraint by phi times P prime. And if the constraint is binding, then our shadow price mu is positive, and relaxing the constraint has a positive utility value. So in short, the planner recognizes that there's two benefits to having more traded consumption. One of them is the direct utility of consumption. The second one is that we relax the constraint by consuming more. Now, if we compare that to the optimality condition of our private agent, which is in the second line here, the private agents, they just recognize that more consumption increases their utility, but they don't internalize how that affects the exchange rate and the collateral constraint in the economy. So in other words, the private agents ignore this pecuniary externality on the collateral constraint. Now, as a result of that, we can find our first lemma. The first lemma is that a planner values liquid wealth in constrained states more highly than the private agents. So the lambda tilde is greater than the lambda if we are in a constrained state of nature. We can illustrate that very nicely in a graph here. So in this graph, I'm showing the planner's valuation of liquidity and the private valuation of liquidity as a function of how much liquid wealth our agents have. So on the horizontal axis, we vary the liquid wealth in the economy. You can see for very low values of liquid wealth, here on the left-hand side, the financial constraint is binding, and if we are to the right of the vertical bar, the financial constraint is loose. If the financial constraint is loose, so it means on the right-hand side of this vertical bar, then the planner's valuation and the decentralized valuation of liquidity just coincide with each other. On the other hand, if we are to the left of this binding constraint, then the planner's valuation of liquidity, which is given by the downward sloping green line, and the private valuation of liquidity, which is given by the downward sloping red line, they differ from each other. You can see that the planner values liquidity in those states more highly than the private agents, because the planner internalizes more liquidity, not only helps the individual agent who holds the liquidity, but also leads to these general equilibrium amplification effects that will relax the constraint for the other agents. So in some sense, that's the basic intuition of the externality that is happening here. Now, how will the planner use this insight on the valuation of liquidity when she makes her state contingent and intertemporal financial decisions? Well, I have again compared the optimality condition for risk sharing of the planner and the optimality condition of private agents in the second line. What you can see is that these conditions are essentially the same, except for one term, which I am circling as we speak, and this extra term captures again the externality that we can achieve by carrying more wealth into future periods. So the finding, and I have summarized that in the next lemma here at the bottom of the slide, is a planner will carry more wealth into constrained states of nature than the decentralized agents, and if there is no financial constraints, then both the planner and the decentralized agents will agree on how much wealth to carry. So if there's no constraint in the next period, then this mu variable will be equal to 0, and then the first line and the second line will precisely coincide, so then there's no role for intervention. Okay, so now we have talked a lot about Arrow-Debreu securities, right? And I have one more result on Arrow-Debreu securities, and then we will talk about how to actually map this into real-world securities, because we know that in the real world we don't trade Arrow-Debreu. So my last lemma on Arrow-Debreu securities is the following. We can implement the planning allocation in this economy with pecuniary externalities by imposing a tax on the state contingent security issuance of our decentralized agents, and this tax is given by the formula that I am listing here. So the tax corresponds of two parts. The first part, the mu normalized by the marginal utility ut, just tells us how tight are these constraints next period. So if there's no constraint next period, then this term is equal to 0 because the mu is equal to 0, and then there's no role for intervention. The second part captures what's the magnitude of the externality. So it captures how much do we relax the constraint by increasing net worth in the economy, and then the denominator of the term captures how much amplification does that lead to. So if we impose precisely that tax, and I will talk about how to empirically estimate that from the data in a couple of slides, if we impose precisely that tax, then we can restore the socially efficient allocation in the economy, and then we will mitigate financial crises and sometimes even avoid them completely. So how do we map that into real-world capital flows as opposed to arrow securities? Well, in some sense, we can consider any real-world security as a bundle of different arrow securities with a payoff vector that we can describe by some variable x. So, for example, the first example I've listed here is dollar debt. Dollar debt would, and let's think of a discount bond that pays $1, that would pay basically the same amount of payoffs, which is exactly $1 in each state of nature. So this state contingent payoff vector xt plus 1 is actually a constant and equals to 1 across all future states of nature. Because no matter what happens to the exchange rate, no matter what happens to our stock market, we always owe precisely $1. Now coming back to Culver's question, if this is a defaultable debt contract, then we could also take into account the default, and then we would have to modify the payoff vector a little bit to account for that. So what does local currency debt look like? Well, local currency debt is basically a contract that pays us the value of our exchange rate in each state of nature. So that has a payoff profile xt plus 1 omega that is proportional to the exchange rate pt plus 1 omega. Now we can do the same thing with equity. Equity contracts, they pay high dividends in good times, they pay no dividends or lower dividends in bad times, so it's also some form of state contingent payoff vector xt plus 1. Now our main proposition in the paper is that we can obtain a formula for the optimal specific tax on any type of capital flow with one of these payoff vectors by using the following equation, and I will circle it again because it's the main equation in the paper. So we can obtain the optimal tax by multiplying what I call an externality pricing kernel, and that externality pricing kernel is basically just a transformation of our optimal tax rate t plus 1 omega times the pricing kernel of international investors. So we need to just multiply that externality pricing kernel with the vector of state contingent payoffs of our securities xt plus 1 omega. So if this is a dollar debt contract and we have the uncontingent payoff profile like in the second line here on the slide, then the optimal tax would just be the expectation of the externality pricing kernel because xt plus 1 is a constant. If we have some more contingent contract and we can allow for any form of state contingency, then we use this pricing kernel for the externalities to obtain the optimal specific tax. And if a planner imposes the optimal specific tax in an economy, then she would precisely offset whatever externalities there are. So now the question is, how do we actually quantify this externality pricing kernel in practice, right? So far, it looks a little bit abstract, but I will show you that we can actually use a very simple and very straightforward procedure and some magnitudes of variables that we can obtain directly from the data in order to quantify it. So let me maybe jump over this for a moment and let me talk about how I can quantify the externalities and the externality pricing kernels in a typical emerging economy. So I am following a so-called sufficient statistics approach, which was first introduced by Raj Chetty in 2009 in the public economics literature. And the idea of this sufficient statistics approach is that we can sometimes obtain optimal policy measures by looking at a few equations and at a few magnitudes that we can directly observe in the data, and that saves us from having to calibrate and quantify some large-scale model in which there may be a large range of parameters that are actually unknown to us and for which we just need to make up guesses. So how does this sufficient statistics approach work? First of all, we are talking about state contingent externalities, right? So we need to describe the probability space of potential outcomes. And now coming back to one of the questions of Alberto before, I will equate states of nature in which an emerging economy experiences a crisis with states of nature in which this aggregate collateral constraint is binding. So that means we collect different states of nature. We can interpret them, for example, as different years or different quarters in an emerging economy. And if we look at the data, whenever we observe a financial crisis in a particular country, I will identify that with the state of nature in which the aggregate collateral constraint was binding. So my main or my first application of this empirical analysis was the Indonesian financial crisis in 1998. And for example, in Indonesia, 1998 would be one of these instances when the financial constraint was binding. So having identified the states of nature when the constraint is binding, the next thing that we need to do is we need to quantify the tightness of the constraint in order to get some measure for the mu. Now, I do this by applying a first order approximation to the Euler equation of our agents. And this first order approximation just tells us that the tightness of constraints consists of basically the intertemporal elasticity of substitution. So usually writes down the intertemporal elasticity of substitution as 1 over sigma, and we equate it with a value of 2. And the tightness of constraints is the intertemporal elasticity of substitution times how much of a decline in aggregate absorption the economy experienced. So, for example, in an ideal economy, our agents would want to smooth consumption over time. If they face this financial constraint, then they need to cut back on aggregate absorption, and this cutback will be captured by delta y in our framework. And then the tightness of the constraints, simply the intertemporal elasticity of substitution times our delta y as a fraction of total y. That's our first sufficient statistic. The second sufficient statistic is that we need to estimate the magnitude of amplification effects. So how can we best do that? Well, that brings us back to our lemma on financial amplifications a couple of slides ago. A couple of slides ago, I showed that this expression phi p prime over 1 minus phi p prime basically captures how much our financial constraint tightens plus the amplification effects in response to a unit decline in our aggregate net worth. So again, we can use a first order Taylor expansion to the optimality condition of our private agents, and that we can show in the paper that the magnitude of amplification can be approximated by the current account reversal, so the reversal in how much our agents were borrowing, as a fraction of the reversal in our aggregate demand. So it's given by delta current account over delta y, delta aggregate demand. And that's our second sufficient statistic. Now, both of these sufficient statistics consist of readily available quantities that we can observe in the data, and if we multiply the two, and we have done that here in step number 6, we can obtain the optimal tax rate that would internalize this pecuniary externality, and we can just transform this optimal tax rate into our externality pricing kernel, and as a result of that, we have a very simple and very straightforward measure of what was the magnitude of externalities and what's the pricing kernel that reflects these externalities in different states of nature. So then all that is left is we need to look at how much do our different capital flows return in different states of nature. So for example, we know that it is very common in emerging economies that the exchange rate depreciates during crisis. That means the return on dollars is actually more than 100%, because from a local perspective, they need to repay more than they obtained when they borrowed. Our local currency debt will decline in value if the exchange rate depreciates. Stock markets typically decline during financial crisis, and therefore we can obtain a measure for our payoff structure x omega for all different kinds of financial assets that Indonesia had issued in 97 and that came due in 1998. So I just see there is one more question by Alberto. He's asking, in your framework, YT is exogenous. To take it to the data, how important is it to make it endogenous? And the same with YN. So you're absolutely right, Alberto. In the simple model that I have described, I am basically describing an endowment economy. Now in the paper I have endogenized that, and I have added capital investment, and I have shown that the sufficient statistics to regulate capital flows will still remain valid. So it means we obtain the same equation tau omega that we have here on this slide. Now in addition, there is an additional effect, which is that investing more and therefore having more traded goods tomorrow will also allow us to relax the constraint tomorrow, because it provides us with more collateral. So that means if we are in an economy that is at risk of a sudden stop in the following period, there is actually, in addition to the capital flow regulations, a case for encouraging or subsidizing investment in traded goods sectors. So that's an additional effect, but it is independent of the optimal equation that allows us to calibrate the capital flow regulation. I see there's two more questions now. Oh, thank you for the first comment. There is a question by Bojin Wang. If the central bank and the emerging market governments are not lucky to read your paper and thus do not understand the externality, what will be the best way to deal with a crisis that has already happened? Should the central bank try to implement capital controls as soon as possible, or should the central bank raise interest rates instead? Or should it do both? So I think that's actually a very important question. And since it's so important, I have dedicated a slide to it that will come in about 10 minutes. So if you can hold on for a few minutes, Boshin, then I will get to that, and I will try to make sure to answer all the parts that you have asked. Okay, so I have shown how to quantify these externalities now, conceptually. Now let's bring this all to the data. And okay, so Alberto has one more follow-up question. How important is the fact that YN might not be pledgeable? So if YN was indeed not pledgeable, that would be very important. But if you look at the data, you can actually see that in most lending booms to emerging economies, the prime collateral is real estate. And real estate is fundamentally a non-traded good. So I would argue that in all lending booms and busts that we have seen in recent history, non-traded collateral in the form of real estate was actually the main driver. Okay. You're welcome, Alberto. So now let's bring all of this to the data. So what I show on this slide is I'm illustrating what externalities different types of capital flows have imposed on Indonesia during the crisis in 97-98. First, I followed all the steps listed on the previous slide to obtain the externality pricing kernel, and in Indonesia that turned out to be 14.1% in 1998. So what does that mean? It means if you repaid $1 in 1998, you caused an additional cost of 14 cents on other agents in the economy that you did not internalize. So what does that imply for borrowing in different kinds of capital flows in 1997? Well, I looked at dollar-denominated debt, GDP-indexed debt, CPI-indexed debt, rupiah, so that is local currency debt, and stock market investments, under the assumption that these are all one-year investments that will be returned at the end of the year. It turned out dollar debt delivered a return of 218%. So if you borrowed 1 unit of consumption goods in dollar debt, you had to repay more than twice as much because of the depreciation of your local currency. That means borrowing in dollars imposed a 30% externality in 1998. For GDP-linked debt is usually denominated in hard currency, so the externality is almost of the same magnitude, just a little bit mitigated by the fact that Indonesian GDP fell. On the other hand, CPI-indexed debt returned much less because it did not suffer from this exchange rate decline. Local currency debt was worth even less and therefore imposed even smaller externalities because the price level inflated in Indonesia during the crisis. And finally, a stock market investment imposed an externality that's only 1/5 of dollar-denominated debt. So you can see equity investments are really by an order of magnitude safer than dollar-denominated debts. Now, what is not in this list here is foreign direct investment. I would argue that foreign direct investment has even smaller externalities than stock market investments because it's very hard to take a factory that you have nailed to the floor and just repatriate that. So it means foreign direct investment has probably externalities that are close to zero in this kind of framework. Now there is a third column in this table here in which you can see the label optimal tax. So what I have assumed in this column is that financial crises in Indonesia happen once every 20 years, which corresponds to the historical record of Indonesia. So there has been no other episode in the past 20 years since they liberalized their capital account in which they really had a systemic financial crisis. So if you assume that these externalities occur with an incidence of 1/20, once every 20 years, you can see that the optimal taxes that result from these externalities are 1.5% on dollar debt, 1.3% on GDP-linked debt, 70 basis points on CPI-indexed debt, and so on and so forth. Now, Indonesia is not the only country. In the following few slides, I wanted to give you a little bit more of an idea of the size of these externalities across different sudden stop episodes. And this is basically a selected list of sudden stops from a recent survey paper on sudden stops with Enrique Mendoza. So I have listed 6 different emerging market financial crises here. 3 of them during the East Asian crisis, then also Russia, Argentina, and Iceland. And you can see that all of these countries have suffered a severe current account reversal, with the exception of Argentina, and all of them have suffered a significant decline in output. So how do we interpret the case of Argentina? I think that comes close to what Alberto mentioned in our earlier discussions. In Argentina, the main problem was probably not private sector debts that would create externalities, but it was really the government's commitment problem given the overvalued exchange rate and the peg. So in the following quantification of externalities, you will see that there was actually only a very small externality to private capital flows in Indonesia, whereas all the other countries here in this sample, including Iceland, saw a much larger externality. So I just see there is one more question from Colver, which actually brings me back to the previous slide. What would be the tax in FDI? So under the assumption that FDI cannot be repatriated during a financial crisis. I would argue there should be no tax. And as we discussed before, if FDI actually helps us to increase the available collateral in the economy, then FDI may be something we may want to subsidize. So yeah, you're absolutely right with this suggestion. Alberto is also asking that the crisis probability is not exogenous, so how would that change the numbers? So the interesting thing is, in the described framework, the optimal thing for a planner to do would actually be to mitigate crisis quite a bit, but he would leave the crisis probability almost unchanged. Now, in order to find out about that, we cannot rely on the sufficient statistics approach, but I had to rely on a calibration of the model in which I can see this basically counterfactual on what would happen if we impose these taxes and we allow the probability of crisis to endogenously adjust. Okay, so now we have identified the crisis episodes here on this slide. Let's look at the externalities that result from that. So you can see here in columns 3 and 4, I have calculated the two sufficient statistics, the tightness of the constraint and the amplification factor. And in the last column on this slide, I have quantified the externality of a marginal capital outflow. You can see these externalities range from 40% to 61% in the case of East Asia and Iceland. In the case of Russia, it was a little bit smaller, 28%, and in the case of Argentina, 6.1%. So again, this suggests that in the case of Indonesia, there was actually a much smaller externality to the private flows than with the other emerging economies. Now, what does this imply for our optimal capital flow regulation? So here on this slide, I've just listed how much the exchange rate depreciated during the crisis, how much the price level inflated, what was the return on dollar debt, the return on GDP-linked debt, on inflation-indexed debt, on local currency debt, and on stock market investments. And we can see all kinds of numbers. Generally, you can see that as we move from dollar to more and more contingent forms of finance, the returns decline. So let's say in the case of Thailand, the return on dollar debt was 176%. The return on a stock market investment was 59%. This is all gross terms. So 59% means you had a loss of 41%. And it's similar for all the other countries. Now in the following slide, I translate this into the optimal tax on different types of capital flows. You can see in the case of Thailand, the optimal Pigovian tax that internalizes the externalities that we have quantified are 2.5%. The optimal tax on equity investments is only 0.8%. In the case of Iceland, the optimal tax on foreign currency debt is 2.56%. In Iceland, the stock market really collapsed. So it means the optimal tax on stock investments would have been only 0.08%. Generally speaking, I guess the lesson that we can draw from these numbers is that we want to impose relatively significant taxes in the order of 1, 2, 2.5% on foreign currency debt, much smaller taxes on local currency debt, and generally taxes that are less than 1% on stock market investments. So this really reflects this notion that a planner wants to discourage the dangerous forms of finance and shift the liability composition towards more contingent forms of finance like stock markets or equity investments and local currency investments. And that will make our economies significantly more stable in the sense that the magnitude of financial crisis is reduced by a lot. So the most dangerous thing in a financial crisis is to have a large amount of dollar debt. Now, I see that I have only 6 minutes left for my presentation. Let me talk briefly about implementation. So in the economic literature, we call things Pigovian taxes to offset externalities. But there is nothing in these simple models that would say that taxes are more preferred to quantity regulations. For example, in many situations, I think it's desirable to just forbid foreign currency mismatches or foreign currency loans in general, or to impose unremunerated reserve requirements or banking regulations that discourage the dangerous forms of finance. So just because we call it Pigovian taxes does not mean that we don't like quantity restrictions. My personal opinion is we should use whatever works. And if a country has experience with, for example, quantity restrictions, then it is much more desirable to use those than to come up with some completely new framework of Pigovian taxation. So there is a difficult tension in the practical implementation. Sometimes we see a lot of evasion that takes advantage of the fact that we impose different types of taxes on different types of capital flows. But the problem is imposing these differential capital requirements is really what is most desirable from a welfare perspective. So one extension that I will speak about in a moment is about maturity structure. And sometimes policymakers have been very successful in encouraging a longer-term maturity structure by using, for example, unremunerated reserve requirements that you can impose only for the first year, and after that year, things just fall back. So it means you face no more reserve requirement, and implicitly policymakers encourage the long-term flows. A counterpart to taxing capital inflows that create externalities when they lead to outflows during a crisis is that we want to encourage capital inflows in a crisis. So generally speaking, if we can attract scarce capital in the middle of a crisis, and many times the lenders from whom we will be able to attract them consist of international financial institutions, then there's really large positive externalities to these capital inflows, because the capital inflows kind of interrupt this feedback cycle. They will interrupt the balance sheet effects, the contractionary depreciations, and that will lead to welfare gains that are much larger than the capital flow itself. So I think this is something that creates a really important role for crisis lending, for emergency lending. I just see that Alberto told me that I can take a little bit more time. So let me maybe give you a quick overview for those of you who have to leave very soon. Let me give you a quick overview of the kinds of extensions and robustness exercises that I have conducted in the paper. And I will spend maybe 5 more minutes after our official time is over to go through each of them in detail. So in the robustness section of the paper, I show that we can generalize the model to several extensions, and that our sufficient statistics approach is robust to all of these extensions, in some cases with additional insights that I will point out as we go through with. So in particular, the exercise is robust to ex post policy interventions like those that Bojin asked about a couple of minutes ago. It is robust to a more general maturity structure. So remember, in the baseline setup, we only had 1 period bonds. In practice, we know that we have more general maturity structures. It is robust, or actually it can be made equivalent to outflow controls during crisis, but there's also certain problems associated with that. We can introduce capital investment, time-varying leverage, like what Brunnermeier and Peterson speak about, and also over-optimism. And our sufficient statistics approach can really deal with all of these extensions. Now, in the paper, I also have a calibrated DSGE version, which allows us to, first of all, reproduce the kinds of financial crisis dynamics that we see in the data, and then also reproduce the same externality analysis that we obtain from the sufficient statistics approach. So in this DSGE chapter, I can show that as long as our crisis that we simulate in the model replicate the same crisis that we see in the data, they will generate the same sufficient statistics, and therefore they will generate the same externalities. So in that sense, our sufficient statistics approach applies equally to a DSGE model as it does to the data that we can directly read from, for example, the international financial statistics of the IMF. Now, one benefit of the DSGE section is that it allows us to engage in counterfactual policy experiments. So if we have time, I can speak also a little bit about that. But yeah, let me now go through a couple of these extensions step by step. The first one, and that goes back to, I see there's one more question in the chat box from Uruguay. So the question is, do I have any thoughts on how to implement the sufficient statistics approach ex ante? Well, so one problem whenever we want to calibrate anything in economics is we need to decide what to base ourselves on. So no matter if we want to calibrate the DSGE model or we want to use sufficient statistics or something like that, we need to ask, well, what do we actually want to replicate? What we generally do is we need to rely on historical data. So if we calibrate a DSGE model and we want to capture financial crisis in that model, we typically look at historical financial crisis and say we want the model to replicate that crisis. If we use the sufficient statistics approach, we need to essentially do the same thing. We need to say, well, we use historical crisis episodes in order to guide what the externalities during such crises are for the future. And in some sense, whenever we engage in counterfactual policy analysis, there is a certain extent of extrapolation involved. So if I write down a DSGE model and calibrate it based on some past crisis, and I say, this suggests the following policy response, then I'm extrapolating from the historical data into the future. If I use my sufficient statistics approach, I'm doing precisely the same thing. I'm also using the historical data and extrapolating into the future. And that's a problem that we economists just cannot get around, especially if we study financial crisis. There is very few observations, and fortunately, I should say, there is very few observations per country. If we look a little bit at cross-country analysis, like what I have done here a few slides ago, it gives us a sense of what the externalities are that different countries have experienced. Okay, so actually, since it's already quite late, there's one thing that I wanted to point out on my conclusion slides for people who may have to leave early. I will give a workshop on how to calibrate capital controls, how to manage the benefits of and costs of international capital market integration in Kuala Lumpur in late August. And that's at an organization that's kind of a sister organization of SEMLA by the name of season, and I spoke to season and participants from Latin America, and in particular from similar member countries, would be very welcome at this course. So if anybody is interested in learning more and learning more hands-on on this approach, please send me an email, and send me an email also if you have any other questions. My contact information is available here on this slide. Okay, so having said that, let me go back to these extensions that we want to cover in the last 5 minutes. So Bojin asked about this, and I think it's a very important question in practice. When should we intervene using these prudential controls, and when should we intervene ex post once a financial crisis has happened? So ex post, that would be kind of the Alan Greenspan approach, that we should mop up after a crisis. So the general principle that I advocate in the paper, and there is in developing theoretical literature that strongly supports this, is that it would be unwise not to use all the tools available. So if we have prudential tools in addition to ex post interventions, let's use all of them, because we know that we cannot fully address financial crisis using only the ex post tools. We also know we cannot fully address them using only the ex ante tools. So it is desirable to always use a mix of the two. Now there's one caveat, which is that ex post interventions may create moral hazard. So especially if ex post interventions come in the form of bailouts, we know that they induce even greater risk taking. And then this risk taking, this higher risk taking, calls for even further prudential intervention ex ante to curb the risk taking. So there's two general types on ex post intervention. One would be what the literature considers first best interventions. First best interventions would be something that completely gets rid of the market imperfection. So something, for example, that gets rid of the financial constraint that agents are facing. Now the problem is, such interventions generally require lump sum transfers, and we know lump sum transfers are theoretically interesting, but they don't exist in the real world. Therefore, I would argue it is close to impossible to fully resolve financial crisis ex post. Second best measures would be measures that relax the constraint while introducing another distortion. So Bojin's example, for example, was to raise interest rates, which will keep the exchange rate a little bit higher, but at the same time kills the domestic economy. That would be second best because it has the side effect of hurting the real economy. Other examples would be bailouts that are financed with distortionary taxes, or emergency lending that will only partially be repaid because the lender is taking on credit risk. So in all these situations, and I show it for a generic measure in the paper, it is desirable to use a combination of both ex ante capital controls and these ex post measures. And there is actually a nice paper by Gianluca Benigno and his co-authors who investigate this in the context of an emerging economy. And I also have a paper that looks in the context of asset price feedbacks with Olivier Jean. Now, one interesting fact is, no matter what ex post measures we introduce, the sufficient statistics for capital controls that I have developed a couple of slides ago, they're still the accurate and correct representation of externalities created by capital flows. So in a sense, our sufficient statistics approach is robust to introducing and considering various kinds of ex post interventions under the assumption that we measure the externalities given that the ex post intervention has taken place. So to make this more tangible, let's look, for example, at Indonesia in 1998. The Indonesian central bank raised interest rates at the time Some people say they raised it actually too much. But given that they engaged in this ex post policy measure of raising the interest rates, our sufficient statistics approach tells us what the externality of capital flows to Indonesia were in 1998. So it is robust to that. Now, let's talk a little bit about a general maturity structure of liabilities in this framework. So introducing a more general maturity structure amounts mostly to introducing more notation. So I don't want to go through it in detail, but let me just mention that we can introduce an externality pricing kernel that spans multiple maturities, not just the next period. And then we can price any long-term securities using this long-term externality pricing kernel, and it allows us to obtain a measure of sufficient statistic measure of externalities created by long-term capital flows. So one interesting thing is, if we are very close to a crisis, then long-term securities reduce the externalities imposed on the economy significantly. But in the long term, the externalities of long-term securities and short-term securities kind of wash out. So it means the only benefit of long-term securities is if we are close to a financial crisis. So the next issue I'll briefly cover concerns outflow controls. Conceptually, it does not make a difference if we tax capital inflows when they come in or when they flow out. So in the model, these two things are really the same. In practice, however, we know that there is quite a significant difference. So what's the problem? In practice, outflow controls raise time consistency problems because even if policymakers say, well, I will introduce these outflow controls in the event of a crisis, the investors will say, well, come on, this isn't really a crisis, you're just trying to expropriate us, and so on and so forth. So we can avoid these discussions, and we can avoid this semblance of expropriation that ex post outflow controls may create by simply imposing inflow controls during good times rather than outflow controls in bad times, and economically speaking, it's the same. Now there's one important benefit of outflow controls. They can be very effective even when crises are quite unanticipated. So let's say there is a country that had no idea how fragile its banking system was and therefore did not use any ex-ante controls. In that case, it may be very beneficial to resort to outflow controls when a really severe crisis happens. I think a good example would be Iceland in 2008, when even the IMF advocated the imposition of outflow capital controls. So, one more thing, how should capital controls respond to over-optimism? I think this is a problem that most policymakers have to deal with a lot in practice. They often have a sense that private markets are a little bit exuberant, and I think right now we may be in one of these episodes of exuberance when private markets just provide large amounts of finance at very low cost. So how should we deal with that? There's two basic strategies. One is a so-called paternalistic strategy in which the policymaker just forces private agents to follow his beliefs. Now, that could potentially amount to very large interventions. And here on the slide in the first equation, I'm showing what optimal interventions would look like in such a framework. So the optimal tax when the policymaker and the private agents disagree on the probability of a sudden stop state. Let's say the policymaker has a social probability, which I call here on the slide pi s, and private agents have a private probability, pi p. What a policymaker would do is he would impose potentially humongous taxes in order to induce private agents to abstain from taking on risk contingent on crisis states. Now, what's the problem with that? So there's one big problem, which is nobody knows who is right. Nobody knows if the expectations of the policymaker are really correct or if the expectations of private agents are correct. And it is very difficult to justify this gigantic amount of intervention based on basically belief disagreements between policymakers and private agents. Just to give you an idea of the magnitude. So let's say the policymaker thinks that the probability of a sudden stop is twice as high as the private agents. Then this first fraction here, pi s over pi p, would be equal to 1. And then even if there is no externality, even if this right-hand side term with the usual externalities is equal to 0, this would justify a tax of 100%. And you can see that this is really problematic if we impose such large measures just based on belief disagreements. Therefore, I would argue that we should be extremely careful about these paternalistic capital controls. I will cross them out here on the slide. And instead, I want to argue that policymakers should proceed non-paternalistically. So what does that mean? It means that the policymaker would respect the expectations of the private agents, but value the externalities that they impose on other agents using the policymaker's expectations. And I have analyzed that in the paper, and it turns out that the optimal Pigovian tax in this case looks somewhat similar to the previous example, but what you can see is the planner only imposes a tax when there is one of these cases where we have an externality. So when there is a binding constraint in the state of nature that we want to regulate. And what the planner essentially does is he measures the externality, and that's here in the second circle, in the right circle, the one that I have left now. And that externality will be measured by exactly the same sufficient statistics approach as before. And then the policymaker blows up that externality by how much he thinks that private agents undervalue the probability of the crisis states. So for example, if the policymaker thinks the crisis is twice as likely as private agents, then the policymaker will multiply the externality kernel by 2. So what this does is it lets private agents behave the way they want. It does not paternalistically distort the decisions of private agents as long as there is no externalities involved. But whenever there are externalities, it measures the externalities at the probabilities of the social planner. And I think that's in a sense the ideal compromise between paternalistic behavior and optimally addressing externalities. So when private agents make losses because they were over-optimistic, that's their problem, and we don't need to intervene in that. But if they impose externalities on others, that's when policymakers want to intervene, and that's when we have a very good justification for capital controls. So we have one more slide to go, which is on capital controls or macroprudential regulation. So this is based on a new working paper with Damiano Sandri from the IMF. Now, when do we want to impose capital controls and when do we want to impose macroprudential regulation? So the big question is there any significant difference between lending to foreigners versus lending to domestic agents? And what we find in this paper is that repayments to foreigners lead to a loss of domestic purchasing power, to a transfer problem, whereas repayments to domestic agents keep purchasing power at home. So as a result of that, it is desirable to regulate borrowing from abroad much more heavily than regulating domestic borrowing. And that means we want to impose more capital controls than macroprudential regulation, because we want to discourage this transfer problem from happening. I just see that Maria Jose has posed another question. So the question is concerning the extension over-optimism. Some of the behavioral finance literature suggests that financial crises are in part due to overconfidence within collectives, as well as to cognitive biases in individuals, which lead individuals to overinvest or have an excessive risk appetite, despite contrary market signals based on real available information. Could your model be enriched with this literature? So that's a good question. Let me quickly jump back to this slide here and let me clear it up. So what I have assumed in this slide is that there is one set of expectations of the private sector and one set of expectations that the social planner uses, and I've just taken them exogenously as given. Now, the question of Maria Jose is, well, if these distorted expectations of the private sector come from cognitive biases or from overconfidence, does that change anything? Well, I would say it doesn't change anything. I would say it would still put us squarely into this area where I would argue for non-paternalistic intervention. Now, the second part of the question of Maria Jose is, if we have very clear market signals based on the available situation that individual agents are behaving completely irrationally, would that change anything? And in some sense, I have to admit that's a philosophical question. If you can clearly see that some financial speculator is speculating wildly and will have large losses, but those losses don't create externalities, do we want to intervene? So Hayek would definitely say, no, that's the problem of that individual agent. I think if it's really obvious, then there may be a reason why we want to intervene paternalistically, like what I have listed here under point 1. But otherwise, I am much more comfortable with the notion of saying we let individual agents suffer whatever losses they have, as long as they don't impose externalities on others, and we only regulate the externalities that will be put on others. So large banks, for example, will always impose externalities on others. And that's why we always want to impose regulations when large banks engage in excessive risk-taking. Does that answer your question? Okay, great. So I think we have come to the end of our presentation, so let me just conclude. What we have shown here in these slides are that emerging market crises with financial amplification create a pecuniary externality. This pecuniary externality leads to excessive risk-taking in the financing decisions of emerging market borrowers, and we have developed a clear framework for policy interventions in such a situation. So we have characterized the externality pricing kernel in such an economy. We have shown that we can quantify Pigovian taxes to internalize these externalities, and imposing these policy measures reduces volatility and can increase social welfare. I have already mentioned the longer workshop that covers these topics for an entire week before. So let me conclude the presentation part. I will still remain available if anybody has specific questions or more general questions related to this topic. I see somebody is typing a question.
I'm impressed, Anton. 2 hours without drinking a sip of water.
Okay. Yeah. So if there are no further questions, I think we have reached the end of our presentation. Feel free to email me if you have any other follow-up or if you would like to discuss things further. I would also be available by Skype or phone.
Well, I think I don't have to repeat what everyone is saying there, Anton. I think it was very clear, an interesting presentation, a very important topic for all of us interested in central banking and international finance issues. So thank you very much for the talk, and thank you all the attendees. I just want to remind you that we have these seminars every week through the same platform, and the schedule is available at the web page that I pointed out there. And just a reminder, next week we'll have Ken Kotner from Williams College, who will talk about his paper on can non-interest rate policies stabilize housing markets, where he presents evidence from a panel of 57 economists. So again, thank you very much, Anton.